Today, we're going to talk on some of the biggest insurance mistakes that I see every day. Imagine you bought the insurance policy, you filed it in a drawer, you pray you never need it, but the worst moment of your life happened and that expensive piece of paper is completely worthless and you won't know it until it's too late. Every single day, people discover their insurance coverage is useless in a hospital room or with staring at the red car. They didn't get scammed, they actually fell into a classic trap the insurance industry quietly counts on you to make. Mistake number one, setting and forgetting. Mistake number two, hiding small details. Mistake number three, the deductible blind spot. Mistake number one, imagine you bought a life insurance policy at 25. You are single, renting a place, you have no dependent. 10 years down the road, you are 35 with a spouse, a mortgage, and two kids. Your lifestyle costs 3 times as much. Your coverage hasn't changed at all. Some of the rule is that if you happen to have any major life events such as marriage, a new baby, a salary bump, or even buying a home, take at least 10 minutes to audit your coverage numbers. Your coverage gap is real and growing. Insurance is a reflection of your current financial responsibility. A policy designed for a 25-year single renter will not pay off a 30-year loan and 2 college education. 10 years, life changes fast. A decade of marriage, kids, and a mortgage can triple your financial obligation overnight. 3 times cost multiplier. Average lifestyle cost can triple within 10 years, but most policies stay frozen at the original amount. And all it takes is 10 minutes time to audit, and you'll be able to match your actual financial responsibilities. Mistake number two, I'll just leave that out. Your cholesterol was high 2 years ago, but you didn't take medication, so you check no. You smoke socially on weekends, you check non-smoker. You think you're saving money on the premium, but you're actually voiding your entire policy. What you think actually happened is that you think you got a lower premium today and don't have to worry about it again. But actually what happened is that when there is a filing of a major claim, the insurer will pull your full medical record from every hospital that you have ever visited. If so happen one of the hospitals have a contradicting note, you will have your claim denied and your policy cancelled. This also actually happened in a real life scenario where I have a client who applied a policy with me and we did a full disclosure. And so happened the client actually got an exclusion for cancer because she has a history of cancer in the past, but she was covered for any other thing besides cancer. But her nephew, who is working in that same insurance company, says that I can help you to apply and you will get the same coverage, but you will not have that exclusion. And lo and behold, the nephew helped her to apply and the policy went through as standard without any exclusion. But I will have also warned her that by not having a proper disclosure, this is the problem that you will face, and she decided to undertake that risk. All right. So investigation normally happens at claim time. Insurance companies do not normally investigate your medical history when you signed up. All they probably ask is, some of the basic questions, and hopefully you tell the truth. They will investigate when you make a claim, sometimes maybe say 5 years down the road. If they find a single doctor note predating your policy that contradicts your application, they can legally deny your claim and cancel your policy for non-disclosure. And imagine you paid premiums for years, you got a rejection letter when you needed the money the most. Be brutally honest with every application. That is my advice to every applicant. So stage one, when you apply, there's no investigation, you self-report it. And so happen if you have a lower premium because you hide some of the details. Stage two, when you decided to claim, for the process will be full medical record will be pulled. If there's any discrepancy found, claim will be denied and the policy will be cancelled. All right. Mistake number three, chasing the cheapest premium. Comparison sites nowadays, maybe in online or elsewhere, makes it very easy where they show you multiple policies. Let's say policy A is 150 a month and policy B is 80 ringgit a month. You'll obviously click the lowest one. You'll probably choose for policy B instantly. But you miss the fine print where that saving could cost you thousands when you actually need to file a claim. Why so? This is what I call the deductible blind spot. So let's assume policy A is 150 a month. There is no deductible, and the insurance company will pay from first dollar itself. Whereas for policy B, it's 80 ringgit a month, almost half the price, but there is a 2,500 ringgit deductible. What this means is that you will have to first pay the 2,500 out of your own pocket before insurers will actually pay a single cent. This is where a fender bender costs 3,000 to fix. With policy B, you actually pay 2,500 and the insurer covers only 500. If you don't have 2,500 sitting in your emergency fund, you don't actually have insurance. Cheap premium usually means expensive claim. Always compare deductible, not just monthly costs. So maybe today I'm going to give you a workshop. Don't call your agent yet. Run this yourself first so you own the numbers. First, calculate your gap, your total debt, such as your home loan, your car loan, plus 5 years of your income. If your life insurance payout doesn't match that number, you have a gap. Check your exclusions. Open your health or medical policy illustration. Find the exclusion page. Know exactly what disease or pre-existing conditions are not covered. Third, emergency funds match. Check your car, home, and health deductible. Your emergency savings should cover all of them instantly. So lastly, insurance isn't supposed to make you rich. It's supposed to keep you from staying poor. Stop leaving your financial safety net to chances. Stop assuming your old policies still work for who you are today. Run the audit this weekend. Your future self will thank you. So I'll summarize. Audit your coverage, match it to your current lifestyle. Be honest. Make sure that if you are applying for an insurance policy, have the full disclosure on the application. Right. Lastly, check for deductibles and fund your emergency reserve. Also, another thing to take note is that some policies may be cheaper, but the sustainability is actually cut short in order to, agents, they are fighting with one another to get your business. So sustainability is also an important key to look into to make sure that you're not faced with a letter in the future to say that, look, your policy is about to lapse because this is insufficient to sustain your policy. Say you wanted all the way to age 100, but right now you're 70 and insurance company will say that, oh, sorry, you will have to top up and X amount you have to pay for this. And at 70, when you're asked to pay a lump sum, that is an exorbitant amount of money, which you could be looking to use that money for your retirement for another 10, 20 years. All right. So if you have any questions, you have any inquiries, feel free to visit my social, and I look forward to talk to you again in the next video. Bye-bye.